Hello and welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. Today, we're going to be looking at Rightmove. The goal for this show is to help you improve your business acumen by being able to better read financial statements. And we do that by analyzing financial statements of famous and well-known companies. So who are Rightmove? Well, Rightmove are a well-known UK company. They're in the FTSE 100, so a pretty large business. And they're actually the largest online real estate portal, right? And property website. So essentially, real estate agents would pay them to publish real estate openings and offerings on their website to reach a bigger market. And in fact, that's actually their largest income, which comes from property advertising, which we'll talk about that in a moment. One quick note to announce about this company. They've recently announced that they're going to be hiring a new CEO. And the reason for that is they wanted someone new to be able to reverse the share price decline that they've been seeing for the last year or so. And we're going to talk about that share price. And a quick note on the share price, actually. If you invested back in 2006 when they had IPO'd, you'd be sitting on a profit of, let me check my notes, 1,291% increase. So it's not bad. If you invested 5 years ago, you'd be sitting on an increase of about 37%. And if it was a year ago, you'd be sitting on a decline of 23%. Hence why the shareholders were pretty upset and they wanted a new CEO. So stick around for that because we're going to talk about the share price after we talk about the financial statements, so you get some context and the full picture here. So Ted, over to you. Let's share with our viewers what we found about this company and how they can analyze the finances of a company like this or even someone similar.
Excellent. Good to see you, Moeed, and welcome to all of our viewers, or should I say welcome back to our subscribers. Welcome to our new viewers. So here we go. Here is Rightmove. Let's pull up their accounts. So annual report and accounts is available on their website, and this is the annual report for 2021. Now, a lot of information on their annual reports about who they are, what they do. So Moeed gave you a flavor for what these guys are doing. And if you want a little bit more information about who's involved and their pedigree of the board, etc., then you can get that by reading this financial statements. But we are going to go through all of the spiel and get through to the actual physical numbers. That's what we're really interested on this channel. So here are the numbers. And we are going to start with the income statement. So the income statement appears, you can see, quite a long way down on page 116 of 160. Revenue. So these guys are generating revenue £305 million compared with £205 million in 2020. So a significant increase, nearly 50% increase, growth on growth. You'll notice these guys also, they have no cost of sales. In effect, they're selling space on a website, and the cost is really here in terms of maintaining that website. So these guys, they don't really have a cost of sales. They're just selling advertising space or space on a website. And their aim is obviously to be the the go-to place. So rather than me looking through 15 different estate agents' websites, I can just go to Rightmove and I can see it all in one place. And there's a sort of a buy-in from the estate agents into that. And so that becomes a slightly self-fulfilling prophecy. So this has been a very successful business model because the estate agents are all bought in. So the estate agents are on there, so the viewers will go there, and the viewers go there, therefore the estate agents are on there, and effectively it creates this lovely network effect. Very difficult to compete with that, very difficult to set up a competitor to Rightmove. So effectively it's operating in a form of monopoly. Now I know that there are other aggregator websites out there, but these guys are really the monopoly because they've got the estate agents that are on board, so to speak. So the operating profit, very, very high. I mean, this is just a cash generating business, effectively. £226 million. There's a little bit of debt. it's actually finance leases, nothing really to kind of worry about. You know, we look at interest cover, it's kind of, you know, we're in the thousands of times, and they're paying tax because they are based here in the UK and they are very profitable. So bottom line, 183 million pounds profit, a net profit margin of 60%. Now, Moeed, I don't think in our years of doing this, we've been doing this for a couple of years, I've never seen a business with a 60% net margin. So this is just massively profitable. 53% in the previous year, 60%. This is effectively, you know, this is an ATM which is just printing money. It's kind of like it's just spewing out the money, and that's what the shareholders have bought into. Looking at the balance sheet that sits behind it, we can see here in terms of the non-current assets. So these are the things we need to run the business. There's some property, plant and equipment, about 12 million, not an excessive amount, and 21 million of intangible assets. Now, you can have a look at note 14. I can tell you now that that is really a mixture of goodwill and software. So they'll capitalize the software, the website that they're using. There's several million capitalized there. There's goodwill because they have grown by buying other similar organizations. So they've kind of consolidated and really kind of that's a buying out the competition or buying access into new markets. So there's goodwill sitting in there as well. There's a little bit of client relationships, which I think is kind of an interesting one. I'm never quite sure exactly how that kind of is measured, but anyway, it's in there. Current assets. You'll notice here the current assets, obviously there's no inventory because they don't actually sell anything, they just sell a service. Trade and other receivables, pretty consistent. Those trade and other receivables is basically you know, estate agents who have advertised and then have to pay the fee for that advertising, and there's 28 days collection day, so that looks pretty reasonable. And then they're just stuffed full of cash, so there is a lot of cash sitting on this balance sheet. You'll notice there's a big drop in cash, so it's gone from 100 to about 43 million pounds in cash, and we'll look at why that is in a minute. On the liability side, liabilities not a problem. They've got some trade and other payables. Here they are. The current liability, I'm not sure what those trade and other payables are, given that they kind of, you know, they don't spend a lot of money on, you know, they don't buy stuff, for example. In terms of their liquidity ratio, we compare these two numbers. Liquidity is just not a problem for them. They're stuffed full of cash. You know, this is a pretty solid balance sheet. There's no debt. They don't need any debt. They're just generating more cash almost than they know what to do with it. So this is like almost like a mini version of kind of Facebook or Apple, where they're just generating a lot of cash. And here is a hint as to where that cash is going. So these guys, if you remember, they make a profit in the year of 183 million pounds, and their retained earnings have fallen, which suggests to me that either they're paying dividends or they're paying out share buybacks, but they're doing more than they are in a profit. Now, that's fine in terms of returning money to your shareholders, but it's not sustainable. So we need to be careful that when we see these numbers, it's not going to happen every single year, or at least not at that rate. So there's our balance sheet. No gremlins there, pretty straightforward and looking pretty solid. Let's look at this movement in equity to see if we can see what is going on with that retained earnings. So we're looking at this column here. We can see the previous year they made a profit of 100 million or 110 million, and there was share buybacks, this cancellation of own shares. Effectively, these are the share buybacks in the market. So they spent 30 million buying back their shares. In this year, they started with 133 million of retained earnings. There's the profit coming through from the profit and loss account. They're paying a dividend. That's the first time they paid a dividend, or certainly they didn't pay a dividend the previous year. And then again, a big share buyback program. So in total, these two numbers together making about 140 million pounds compared with a profit of 183 million. Now, obviously, sorry, 240 million pounds compared with 183 million pounds of profit. So just to kind of be aware that, you know, their share, you know, the number of shares they're buying they're buying back their shares in the market. The number of shares in the market is going down, and effectively that's driving capital growth, or they're trying to drive capital growth through that share buyback. We'll see if they've been successful by looking at their share price in a minute. So the number of shares in the market is going down, but they can't carry on doing that. They are making a lot of money, but they're not making enough money to keep that on a sustained basis. And that cancellation of shares, if we just nip back to the income statement up here, you'll notice that the earnings per share has risen. The basic earnings per share has risen, and that is not, some of that will be driven by the increase in the profit, but also it will be driven by the reduction in the number of shares in issue, and that reduction in the number of shares in issue is driven by these guys undertaking a very big share buyback program, and therefore sort of almost artificially inflating that basic earnings per share. Now, this is interesting because you might want to have a look at the director's remuneration and see whether they are incentivized on earnings per share. So if you are a director of this business, you may have a earnings per share as an incentivization, so therefore you are incentivized to buy back your own shares, and B, you've probably got some share options, and if you do have some share options, then obviously you're going to benefit from a rising share price, so you have a benefit of buying back shares. Obviously, if you have share options and you pay a dividend, you do not benefit from that. So finally, let's have a look at the cash flow statement, see what's going on here. So cash flow, we're looking at the profit from the year, that's the top number, and then the cash from operations, very, very cash generative, so generating lots and lots of cash. No massive differences going on in between these two. You can see that they're kind of, there's a tax being added back and then taken back out again. That's just what's accounted for, what's physically paid. A bit of a movement here in their working capital. Again, no big, there's no big amounts being tied up anywhere or being released anywhere. And there's a little bit of depreciation and amortization on those tangible and intangible assets. So generating lots of cash, 195 million pounds in cash. In terms of their investments, they're not really investing. It says that they're investing, but actually they're just stuffing money into money market deposits. So this is just basically, parking cash on one side. So not a huge amount of investment, little bit of software development, little bit of a couple of new computers for the lads, etc., etc. And so really the big movements in their cash is coming through that share buyback and the payment of dividends. So these are really the big numbers. And then you'll notice here, like things like purchase of own shares for share incentive plans. Well, as we said, they've been giving share options out to their staff and to the directors, and then when those share options are exercised, they have to go out and physically buy those shares, or they use ones which have been previously bought and not cancelled. So the cash from the financing activities, negative cash, that's really the driver of the business. So they're basically generating nearly 200 million in cash, and they're spending 243 million in share buybacks and dividends, which is why the cash goes down by about 50 million, and it goes down from that 96 to that 43. So that's the reason for that fall in cash. So I'm not nervous about that. I just know that they can't carry on doing this. This is probably more of a one-off rather than an expected program of we're going to be doing this every single year. So that's the performance of the business. I don't think there's anything else that really kind of jumps out at us in terms of Rightmove. Let's go and have a look at their share price. So we'll just jump back to our presentation. Here it is. So in terms of the share price, interesting enough, it has been coming off the boil. So even though they've been doing their share buybacks, and I don't know the timing of that share buyback, but if we're looking at 2021, perhaps you can see, maybe they took advantage of this kind of this drop. You remember that'll be the pandemic, for example, here. So this big drop will be the pandemic. I'm guessing that they kind of feel that they're undervalued, that they start to do their share buyback, and then once the share buyback stops, we start to find the market is starting to correct them. Even so, they are still trading at 25 times earnings. So when we look at, that is basically exactly what we're looking at. That is so 462 billion as their market cap is 25 times the 183 million times 183 million of earnings. So just to put that in perspective, turn that upside down, you've got a yield of 4%. Okay, so the yield is 4%, which seems quite low to me, which suggests that they're still, I think, quite expensive. Now, they are doing their dividend yield is 1.4%. You'll notice, obviously, they are doing their share buybacks as well. If you include the share buybacks, you're up at a 5.2% total yield of dividend and share buybacks. Although, as we've discussed, that share buyback is not sustainable, so they will not be able to sustain that high level of yield. It's all goodwill. The whole thing is goodwill. There's 70.5 million pounds worth of net assets on the balance sheet, and the value is 4.6 billion. So it's basically all goodwill, and you'd expect that. This is just a website. That's all it is. And your ability to buy into that cash generation, I think, is really, really important. And one of the reasons, Moeed, I think this is, potentially overvalued. And I'm not saying that, this is one of these companies where you kind of go, it's laden with debt, it's going to struggle, I'm going to short it, but I wouldn't put it on my buy list because I think of the headwinds that they're going to be facing. So, we are seeing interest rates going up. And if interest rates are going up, people are going to struggle to buy houses. If they've got a house, they're going to struggle to remortgage it. If they can't remortgage it, they're going to have to sell. And if lots of people are starting to sell, we're going to start to see house prices coming down. Okay. Now, we haven't seen that for many, many years. But those of you who are a fan of The Crown will have been watching about John Major, for example. And that was really the last time in the 1990s when John Major took over from Thatcher. Interest rates went to unaffordable levels as the UK was trying to stay in the ERM, and therefore we started to see a lot of repossessions. Okay, and selling into a falling market is a pretty scary experience. Now, as long as we got the turnover, that's where the estate agents make their money. They make it from turnover. But if they start to see a lack of that turnover, maybe they're going to start to kind of cut back. And do they need to advertise on Rightmove, or do they need to negotiate their fees with Rightmove? So I think we're going to see interest rates going up, which is going to cause house prices to kind of come down. Inflation, the cost of living crisis, the fact that I'm paying more on my energy makes my mortgage even more unaffordable. The Bank of England is stopping its QE. It's pushing up interest rates to combat that inflation. We're starting to enter into a little bit of a perfect storm. It hasn't really started to bite yet. And then we've got a recession, which is forecast to come, the longest recession, forecasting to 2024. I think there's a lot of headway. Anybody in the, and we've looked at house builders as well, anybody in the property market is going to see significant headwinds. So yes, these guys are generating a lot of cash, but that is good news, and that good news is already baked into the price. I can't see the cash going up, and therefore I think that there's a kind of, this is a one-way bet. It can only go down. Okay, now I'm not saying it can't go up, and I'm not saying it can't flatline, but this is not your multi-bagger. This is not your in early before anybody else. The good news is reflected in the price. So there's kind of my analysis for you, Moeed. And just before we finish, I thought I'd just very quickly take you through back to the accounts, because it's always interesting looking at the accounts and seeing the people in charge. So if we go and have a look at the people in charge, we can see on page 92, you will see the director's remuneration. Now, there's a lot of pages about the director's remuneration, and you will see, lots of stuff around, long-term pay and variable pay and bonus schemes and share options, etc., etc. But Peter Brooks is our man in charge. Here he is, Peter Brooks Johnson, and he's earning about 1.7 million pounds. So his total remuneration, 1.7 million pounds. And we can probably see that, the previous year it's up from 960. So he was basically just under £1 million last year, and he asked for a pay rise and he got it. And there he is, 1.7 million pounds. Now, is he worth it? Well, you say that he's, they're looking to replace him. So, I'm sure that, he's done very well and managed to pay for his school fees and pay off his mortgage, I hope. Quite interesting to compare that. So if we go and have a look at on page 136 of these accounts, you can actually see how much the employees are being paid. So page 136, here it is. We can see the number of employees. So the average number of employees is 572. The total wage bill is about £43 million, which means that the employees are paid on average about £75,000 each. So if you're working here, if you're paid more than £75,000, you're above average. If you're paid less, then you are paid below average. But the CEO is earning 22 times the average employee's salary. Now, that sounds quite a lot, but I'm not sure that's totally unreasonable. So, I don't think that the CEO in CEO terms, as a FTSE 100 CEO is overpaid for running this business. But then you could argue it's a pretty straightforward business. It's just a web advertising company. So I thought that was quite an interesting little analysis there to finish off with on Rightmove, Moeed.
Thank you, Ted. That was really, really interesting, and I hope you got some value from that. If you like this video and if you like what we're doing on this channel, don't forget to like, share, and subscribe. Also, this video was a request from one of our viewers, and about 98% of the videos that we publish out there are actually from requests from you. So if you're interested, just like John is, whether you're interested in selling services or products to a company like this and you want to know a bit more about them, if you're thinking about investing in a company like this, or even if we've actually had people who are going for interviews with these companies and they really wanted to look good in those interviews and they asked us for our analysis, which we were more than happy to give. So if you are interested in a company and you would like us to analyze that for you, the easiest way you can do that is just to leave a note in the comment section of any one of our videos. We will capture that and give us some context, give us some story behind why you're interested in that. The more interesting the story, understandably, the higher likelihood that you will be pushed up the priority ladder. So do leave a note in the comment section of a company that you're interested in. So until the next video, thank you, Ted. Thank you, everyone else. Oh, and by the way, if you're interested in other companies that are similar to Rightmove or within the industry that we've looked at, check out our video on Persimmon, which is a UK house building business. We also looked at Open Door, which is a US business, not the same as Rightmove. They're buying up properties and then doing them up and then reselling them for a profit, but definitely one that you can look at for another market such as the US. So until the next video, thank you, everyone.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share, and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions. And do recommend any videos, any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share, and subscribe to the channel. And I will see you on the next video.